Seven Investing Podcast. We're going to try out the live stream here today. We've previously recorded the Seven Investing Podcast. We published it out to Spotify. It was kind of a one-way street. I'm trying to make things a little bit more interactive in a live stream format. We're going to be testing this out over the next week, but bear with me as we get some of these early hiccups out of the way. My name is Simon Erickson, founder and CEO of Seven Investing, and we've been talking a lot about earnings this last week. There's a lot of high profile Mag 7 kind of companies that are making all of the narratives of the financial media right now. I want to talk about a company that's not on anybody's radar named Crocs. Crocs sells $4 billion worth of shoes every year for 700 million pairs of shoes across the entire world. It's not a sexy company. It's not a technology company. It's not a fast growing company, but it's a stock that has got three really intriguing hidden catalysts that I want to talk about here this morning. If you have any comments about Crocs, please go ahead and post them to the live stream. We're sending this out to Twitter and we're sending this out to our YouTube account. Twitter is at 7Innovator. That's the number 7Innovator. And then YouTube is at 7Investing, the number 7Investing. So if you want to see that live during the live stream and actually share some comments of your own, please feel free to do so. But let's go ahead and dig into Crocs. Why is Crocs so interesting? Here's the first thing that I'm looking at is the first quarter results. Came out yesterday, came out on May 8th. Comes out here and says, hey, we're a casual footwear company, and we grew our top line. Look at this, only 1.4% on a constant currency basis. Nothing too exciting there right now. Approximately flat when you strip away the constant currency. We look at it at global. It's a global company, but really nothing sexy. The direct consumer revenues were up 2.3%. 3.5% if you look at constant currency, and then wholesale was actually down a little bit year over year. Gross margin improved. You have some of the operating costs in there. This is kind of a standard earnings release. It's not getting anybody very excited. So what is it that I see in this that makes this so interesting to me? Well, there's a couple nuggets that investors should take away from this. First of all, the company is spending money on share repurchases. This is always a good thing when you see a company that's going to put $61 million to work in buying back its own shares. Says we think the stock is undervalued, we're going to go back and buy our own stock. Always a good sign. Secondly, curiously, the company is borrowing debt. Borrowed $130 million of debt right now and actually used a portion of that for the stock repurchase that we just talked about, right? Now, what do they need the rest of the money for? We'll get to that in a second, but look at this also, $61 million, nothing to write home about, but look at this. This is much more interesting. They have a $1.3 billion share repurchase authorization that is remaining. With Crocs' current market cap of around $6 billion, this is a very small company, $6 billion market cap, that could retire almost a quarter of the outstanding share count at today's prices. If you put all $1.3 billion to work at around a $6 billion market cap, could retire up to 25%. That is an extremely high number, which is very good when you're reducing the denominator for anything on a per share basis, right? Earnings per share, if you have fewer shares, earnings is going to get the compounding effect of the buyback from something like this. And it's interesting to see they put a little bit of work to put a little bit of the repurchase to work this quarter. $61 million is very small compared to the $1.3 billion that they've authorized. But again, this has been Crocs' MO. They go out there, they grow slowly, only 1.4% for this quarter year over year, but they're just buying back this stock that's selling for less than 7 times cash flow right now, 7 times free cash flow and less than 7 times earnings. So that's very interesting, first and foremost. Secondly, we've got a little bit of a problem with the Hey Dude brand. Again, there's the core Crocs brand. This is the clogs. These are the sandals. These are the core brand that you're so familiar with. A couple years ago, they made an acquisition of a company called Hey Dude. It hasn't worked out well. You can see it from the revenues declining 9.8% year over year. That's problematic and a clear sign that we need to turn things around in that brand. And then you've got a little bit more on the outlook here. This is very interesting, is that it's actually withdrawing its full-year financial outlook that was previously provided back in February due to macroeconomic uncertainties stemming from global trade policies. So let's take a little bit of a time out here. Stop sharing. Back to the punchline on what's going on with Crocs. We have very slow growth, 1.4% for the overall business. We've got one division of the company that's declining 9.8%. We saw they took out a little bit of debt. They used a little bit of that to front load inventory, get away from the trade tariffs that are coming up from China, from Vietnam. And we've also seen a little bit of a buyback, even though a very massive authorization is on the line too. So now let's share a couple more interesting catalysts that I see in this stock. I want to talk about a couple of things that might not be obvious in that earnings report that investors should really be aware of. Here's what I see going on with Crocs right now. Again, not so obvious right out of that IR presentation, the PR deck that they sent out there, but you did see kind of the slow top line growth out there. But look at this, earnings increased 13% on just a 1.4% consolidated revenue growth. That's a very lean, efficient cost structure for a business. If you can grow your earnings at 13% when your revenues are only growing 1.4%, that's a really good sign. Probably there's some operating leverage in this business where you've got some fixed costs that you can spread across higher volumes. And certainly if we can get that revenue line item back to around 5 or 6%, that would be an even greater for the earnings, the bottom line number that's reported as well. So I think the first hidden catalyst that I want to talk about is, hey, dude, down 9.8% year over year, pretty much a busted acquisition that Crocs put a lot of money into a couple of years ago. But if we can actually revitalize that part of the business and revitalize that brand, you might unlock even greater earnings potential. And how is Crocs going to do that? Well, last summer they went out and they hired Sydney Sweeney, very popular American actress here, to be the brand ambassador specifically of the Hey Dude brand. If we get that back, even at just break even, or even just maybe 1 to 2 to 3% revenue growth, I think that's going to be the first trigger and catalyst that could push earnings even higher. Secondly, let's talk about that common stock. The repurchase of $61 million was a step in the right direction. But as I just mentioned, if you're actually able to repurchase 25% of your shares with an authorization for the stock that's selling at less than 7 times free cash flow, you do it. And I think Crocs is going to capitalize on this, aggressively put that repurchase authorization to work during the next 12 months. And that's going to be the second catalyst. It's just fewer shares with a slow growing, very, very high margin business. This is the AutoZone template. This is exactly what works so well for AutoZone. They just went back there, kept buying back more and more shares over and over. Slow growth, nothing sexy, but really 30% return on invested capital for Crocs, 24% operating margin for Crocs at a very, very undervalued stock. Go back there and put your authorization to work. And then the third catalyst is going to be more about sentiment right now. I think there's so much pessimism that's surrounding these shares like dark clouds related to these trade relationships with China and the United States. About 25% of Crocs' production of their shoes is done in China. Another 50% is done in Vietnam. And right now there's these reciprocal tariffs. There's a lot of discussions. What's going to be the added cost of importing those goods into the United States and selling into the American market? Is the operating margin that's 24% that looks really good, is that going to get cut in half? Is it going to get worse than that? There's so much uncertainty on what the tariffs are going to do for Crocs' business that I think that's a huge cloud. And one of the reasons the valuation is so inexpensive. But there's a little bit of a light emerging from these dark clouds. First of all, we said half of production's in Vietnam. That was one of the first countries to call the Trump administration and say, hey, what's it going to take for us to get back to 0% tariffs? They tend to want to work with the Trump administration, of course, do a lot of production for a lot of retail companies, Crocs included, Nike included. If they can get the tariff rates down and we show progress of these relationships, that could unlock a lot of faith and trust in Crocs' business, where there's kind of an overhang on it right now. And then the other point is, only 25% is coming from China right now. Crocs can very easily switch around its supply chain. It's not actually directly owning the manufacturing for a lot of these facilities. They're contracting them out. They can ship production. This is not a super heavily guarded IP or anything like that. This is plastic shoes. It's a resin material that was developed in Canada, almost 30 years ago now, 25 years ago. I think it's okay to switch that to other contract manufacturers that might not be as exposed to the manufacturing tariffs that we're seeing right now. So overall, this is not the kind of company you would typically think would be on a growth style investor's radar. Crocs is not a tech company. It's not a Mag 7 company, but it's a very profitable company. And it's a very underfollowed company, and its stock is very, very inexpensive right now. And so if you look at those three catalysts, one of which being related to the trade relationships, one of them being related to the repurchase authorization, and then the third one being related to the business itself and the margin profile and the things that it's looking at for kind of pulling guidance, but really very, very, very profitable. There's a lot to like with this one. Or those are kind of short-term catalysts. Like I think it's done this shooting quite higher, quite honestly. And a profitable business like this has to be on your investing radar. Again, a small cap value company that I think has got some hidden potential there. So wanted to do a quick live stream, 10 minutes, short and sweet. Talked about Crocs, CROX, if you want to follow along with that one at 7 Investing. I'm going to do these more often. I enjoy these live streams, kind of impromptu, right? I don't have a whole lot of talking points right in front of me, but I do like kind of the conversation about companies that I think have got a lot of hidden potential, Crocs included. So I hope you guys have a great weekend. I'll be back with some new updates and some new live streams on earnings next week. And have a good one. And we're here to empower you to invest in your future. We are 7 Investing.